Welcome back. You're watching ET Insight. In 2 weeks after S&P downgraded America's sovereign rating, equity investors around the world lost an estimated $1.8 trillion. Since then, global markets have recovered. But there's no guarantee they won't go down anytime soon. Given the volatility and likely recession in the US and Europe, will smart money flow into India? Asha Gopalakrishnan finds out.
A storm has risen in the Western world, and it will take almost everything in its fold, from trade and commerce to stock markets. And no country can emerge unscathed, particularly emerging markets like India, which have billions of dollars of FII inflows coming from US and the European Union.
In America, there's a very big worry about the macro. But the micro is really, the American markets are really cheap. The companies are doing extraordinarily well. So I don't know how to, of course, sentiment towards equity will surely, be affected on fears of a slowdown. How much this slowdown will hit earnings, I think it's still a question which only time will answer.
But when the dust settles, emerging markets like India may well continue to be the destination of choice, because FII inflows are driven by GDP growth, which in turn is reflected in stock prices of companies. While India's domestic growth has slowed down, it's still one of the fastest growing economies in the world. And even the most pessimistic growth projection for the next 2 years puts the figures between 7.2% and 8%.
There would be a general increase in perception of global risk. One would expect some cutting back of portfolio investment into emerging markets. On the other hand, there's the opposite effect, that if there's greater confidence in the emerging markets' continued growth story, then there could also be the opposite effect of more funds coming into emerging markets.
Banks are now charging for putting deposits in Western world. I mean, that excess liquidity eventually will come to emerging market in search of growth. Their economies are shrinking, but our economies are still growing. So put those two things in together. This is probably a golden opportunity for you to buy selectively and slowly and gradually.
A look at what drives FII inflows reveals more. Apart from earnings growth, exchange rates and interest rates are two key determinants of inward capital flows, and what FIIs seek is high returns calculated in foreign currency. So when they come to India, what they are looking for is the return on their investment in rupee terms and the movement of the rupee exchange rate versus the dollar. But it's not as simple as it sounds. A relatively low rupee rate of return on equities can become attractive in dollar terms if the rupee appreciates vis-a-vis the dollar and vice versa. FII flows go up when there are expectations of domestic currency appreciation. With the dollar looking weak post the S&P downgrade, chances are that FII inflows will rise.
There is a lot of scope for fixed income returns to look bright over the next few months. You must remember that RBI, particularly since the May 3rd policy, has been pretty strong on the monetary policy front, which has pushed, 1-year rates on the CD front to as high as 10%, obviously lower right now, and 1-year government bond rates to, 8.25% or so. There is a lot of room for recovery there if one was to see a turn in the monetary policy cycle.
Next in line is the interest rate differential between India and developed markets. Typically, FIIs borrow from developed markets at zero or near zero interest rates and invest the money in countries with relatively higher interest rates like India. Foreign investments in debt, which are 25% of FII flows, depend on the interest rate arbitrage adjusted for the exchange rate movement. True, interest rates in India may be peaking out, and in developed markets they may start rising in another year or so. But once the spread is adjusted for exchange rate movements, putting money in debt in India may still be a lucrative option. But for equity investors, lower inflation will have its own upside.
There will be an interest rate peaking somewhere, or may have already happened, and actually should have happened in the last cycle, in the last meeting, or at least delayed. That plus the fact that there will be a base effect means that inflation will look good. So in that sense, next year I expect it to be very good actually, maybe 20-25% returns.
And most importantly, there's the impact of inflation on FII flows.
If you look at foreign investors, these are people who have lived in countries and survived and thrived in countries where inflation has been in not double digits but triple digits. And they have learned to go through swings in a dramatic manner. So I don't think they will really be scared and stay away for that reason.
High inflation is a deterrent to FII inflows because it takes a toll on demand and hence growth. But it can also lead to stock prices becoming irresistible.
The global economy slows down, commodity prices go down, and then obviously the inflation will also come down, and government will try to take some counter-cyclical measures. And first thing which will come is probably at least stoppage of rate hikes, and then eventually if inflation comes down, they will tend to soften the interest rate, and hence they'll allow the growth to happen.
We saw inflation being very high. Government was unable to contain this. So RBI has to intervene and increase the interest rate, which will definitely impact our earnings. So there will be a contraction of P, and there will be an impact of this lower earning also. So overall I feel that now at this levels markets are fairly priced. We are discounting 12 earning at around 14.5 or 15.
In effect, the bet pretty much seems to be on India, never mind the intermittent ups and downs.
But India needs to put its house in order to keep global investors interested. But how? Find out after this short break. Stay with us.